Well, good morning, and for those of you who don't know, I'm Vicki Lambert with the Georgia Department of Revenue, and I have the distinct pleasure of being the director of both local government services and the motor vehicle division. I can assure you that the last few months have been interesting and been quite different than what I thought I was probably going to do when I went into the motor vehicle world. Do want to make a couple of one announcement. I'm going to let Matt off easy. But I sort of have a rule when I'm training. I don't really like to hear cell phones. So the way I usually handle that is if I hear someone's cell phone, I invite them up to come up here and sing. So unless you really like to perform in public, maybe we want to put our cell phones on mute or vibrate or something like that so that we can get through the morning, just as a courtesy to those folks sitting around you, okay? Have some DOR folks here. Would the folks from the Department of Revenue stand up? Don Hicks, Grant. Behind me is Crystal Powell. Don Hicks is the auditor for this region. Grant Hilton is the field rep or the field agent for the assessment side. And most of you know Crystal from motor vehicle. So I appreciate them coming to help us this morning. All right, with that, we're going to get started with House Bill 386 because I know that you guys can hardly wait to get started. And also, and I'm not trying to inhibit anybody. Questions are great. Anytime you have a question, just raise your hand. I need you to speak loud enough for me to hear the question so I can repeat it because we're actually filming this session this morning, so we want to be able to get your questions recorded so they can be part of the presentation. But don't let that inhibit you from asking. If I have to stand up here and talk in front of the camera, you can certainly ask your question from behind the camera. All right, this is what we're going to do this morning. We're going to do a review of the legislation. We're going to talk about what it is, how we got here, what we're going to do with it now that we have it. As I told tax commissioners in May when we first talked about this, I said, you know, nobody likes change and it's very scary. And I said, I know you guys aren't happy about this, so I'm going to give you about 20 seconds to turn to your neighbor and mumble and grumble and cuss and fuss and do whatever, and then we're going to cut it off and we're going to figure out how to make it work. And so that's still been our philosophy moving through this. We're going to spend a good bit of time talking about how this money is distributed and how that differs from the way a Valorem tax is handled today and kind of how that changes the process. One of the reasons that we wanted school board people and county finance folks to come to the first part of the morning was to help everybody understand that the money flow is just a little different when you get into the title ad valorem tax portion of it. We'll spend some time talking about appeals and the impact those are going to have on the entire process. And then we're going to talk about that impact on the county tax commissioner's offices, but also on the tax assessor's office as they handle an increase in what I think will be an increase in appeals. This afternoon, when we come back from lunch, will be more a time that we really focus on transactions in the tax commissioner's office and handling those various transactions. So anybody's welcome to stay for the entire day, but some of you just may find the morning the portion that you're most interested in. So let's figure out how we got here and what we have now that we're here. House Bill 386 was part of a much larger piece of, or is a much larger piece of legislation that includes things other than title ad valorem tax. Just fortunately, the first 17 pages is the mayhem and madness that is called title ad valorem tax. There's other parts to it that were to spur the economy. There is the energy exemption and the energy excise tax that the local governments can put into place. I'm not going to get into that today because I am certainly not the expert on that. So we've had other people at the department and the Association of County Commissioners and the City Municipal Association has been working with that. We also have the ag exemption. There were also some new income tax. There's new income tax exemptions for raising the limit on retirement income and those kinds of things. All of this meant to begin to spur the economy and see if we couldn't turn Georgia around a little bit from what we had been through in the last couple of years. This motor vehicle piece is just one part of what was to help spur the economy and to keep revenue coming into local governments. In order to understand what we're talking about and what the title tax, now many of you heard several years ago, this piece of legislation started about 4 years ago. It's had several different iterations and there have been several different versions of it. When it originally started, it was called a title fee. It was going to be a title fee. Early on, there was some conversation that they couldn't call it a fee because if they did, then schools could not accept that money because schools, by Constitution, receive their money either through an ad valorem tax or sales tax. They aren't allowed to accept fees. So when they decided to move forward this legislation, they went through and changed it all the way through to a state and local title ad valorem tax. So for purposes you'll see all the way through this presentation, we lovingly call this TAVT for lack of anything else to name it with, so you don't have to say all of that every time. This piece of legislation also moved through the legislature as quickly as anything I've ever seen in the close to 30 years that I've been watching Georgia legislature. We looked at it on a Monday afternoon, I believe. It went to the committee on Tuesday morning. It came out of committee, went to the House, went to the Senate, and was signed all within about 5 days. It wasn't signed within 5 days, but it had the approval of both the House and the Senate within a few days. Having said that, there's a whole lot of stuff in here that a lot of folks are unclear about. And part of what we're vested with as the folks who are going to be meeting those taxpayers face to face is helping them understand and educating them on what this really means. Most of you have heard someone say the birthday tax has gone away. That's not right. That's wrong. Unless I buy a new vehicle. I don't plan to buy a new vehicle, so I'm going to continue to pay birthday tax on that car. There's also this other, somebody mentioned it to me this morning, that there's this rumor floating around that you can opt in for $300. I'm not sure where that came from. Apparently, some example used somewhere that said for approximately $300, you may opt in. There's also some other qualifiers there, and we're going to talk about that as we move through the morning. There's tons of misconceptions out there. And part of your job and my job is to make sure people understand. None of us like change, unless it's change we initiate, right? You know, if something I want, it's great, but if it's something you want, I might necessarily not care for it. We're going to have a whole group of taxpayers that don't know about it and don't understand it. So that's part of our job, and part of what we're going to talk about today is what we can do to make sure that folks are getting the right story and that we're controlling the message so that we know what they're hearing is the right, rather than what somebody else thinks it says. Because I've had people write the department and say, I can't believe you're going to charge this fee on top of sales tax. Well, that's not right. We're not. So you have to go back and kind of start with the basics. And it's really not easy to explain to someone who doesn't have background. Most of us in this room have some background in this. So it's pretty easy for us to understand, but most of your customers coming into the tax office aren't going to have the background you and I have. So we have to be very careful that we give them the full story so they understand. But let's figure out what we're going to apply the title tax to. We're going to apply it to motor vehicles. Now there's many definitions of motor vehicles. There's this big subclass of property that's motor vehicles, which includes everything in that world, which are trailers and campers and all of those things. But for purposes of the title tax bill, it is only those vehicles which are self-propelled that meet the definition in 40-1-33, and they're required to be titled. So we have a group of self-propelled motor vehicles that aren't titled. They're either old, so old that they never had a title, or they've reached the age where the owner is not required to title them. So those vehicles will still be subject to that ad valorem tax through the system. So ad valorem tax, as we know it, isn't going away on lots of the vehicles that are still out there. So first of all, we have to have something that's self-propelled, and it has to be titled. Now, the next thing we have to do is say, okay, I now know which group of vehicles this applies to, but what do I apply the rate to? Now, today, if I walk into a dealer and I buy a vehicle, they're going to give me this vehicle, depending on how good a negotiator I am, this vehicle is sale price is worth X, whatever X is. So that's their starting point. And then if I have a trade-in, they're going to deduct the trade-in from that. And today, if I were to go buy that vehicle, I would pay sales tax on the price of the car minus the trade-in on that net value. That's what I would pay sales tax on. So if I'm sitting across the table from that sales person in that dealership, he knows what he's selling me the car for. He knows what they're going to allow me for a trade-in. And so he's able to work up that deal. Bottom line, most of us at the end of the day don't really care what the bottom line is. All we care is, do we have enough money to make the monthly payment once we roll that financing in? So most people don't really have a lot of concern about what the bottom line is. But now we have a different set of rules under title tax. Because of the fact that this title ad valorem tax is going to be applied to all titled motor vehicles, including those that sell from neighbor to neighbor, the legislature wisely said, we need to control that starting point, what fair market value is, so that someone can't play games with a bill of sale. Now, I've made the comment a couple of times in training, we don't think taxpayers would lie, right? They might fudge it just a little bit, knowing that the bottom line would affect what they had to pay. So the legislature said, okay, we're going to establish that starting point. Fair market value is going to be based on the same value the commissioner publishes every year for all the vehicles in the state that are used for ad valorem tax. So we're going back to that assessment manual, and that's the value that title tax will be calculated on. Now, for those of us in the tax office, you put that vehicle in Gratis, which is the Georgia Registration and Title Information System, and it pops a value, right? The dealers don't have that same information without going to the manual to find it. So this has been an area that has raised some concerns, and because if they don't collect the right amount of money, they're going to show up in your office and not have the right amount of money. They may have too much, they may have too little. Now, the value we use currently for ad valorem tax is 40%. So we have published, or are in the process of publishing on the department's website, a new manual that basically just puts these values out at 100%, so that the dealer can go to a manual and he doesn't have to do the math, and there's not the danger that somebody's going to calculate the title ad valorem tax on a 40% value rather than 100% value. The next thing would be if you have a used vehicle that doesn't appear in the commissioner's manual. This would be a unique vehicle that just perhaps didn't make it into the document we use. In that case, you have to go to another pricing guide, and the commissioner has designated the NADA as that official guide. So you go to the NADA, and then you look at the taxpayer's bill of sale, and whichever of those is the higher is the value that will be used to calculate the title ad valorem tax. In the event you're one of those folks who just can't wait to drive that new year model off the lot, you've got to be the first one to take out that 2000, in this case would be the 2014 vehicle. That vehicle may not be in our database yet because we would not have gotten the information. In that case, you're going to use the bill of sale less any rebate to be your starting point. Now remember, right at this point, we're just talking about where we start, where that point is that we're going to start in our calculation. Okay? Now, the commissioner's values, just to give you some idea, by statute, those values are the average of wholesale retail. And that's statutory. We don't have a choice but to take wholesale value, retail value, add the two together and divide by 2. That's how complicated that process is for most vehicles. So that's where the commissioner's value is. So in many cases, it may be less than what the bill of sale is. But because of the casual sales, this is the way the legislature has defined the process. Now I've got my starting point. If I buy at a dealer, I can deduct the trade-in value. Only if I buy at a dealer. Again, we don't give credit for a trade-in if you're buying it from a casual sale. Because again, there could be, you know, I want this car, but I'm going to trade you my boat and my microwave and 2 or 3 other things, and so at the end of the day, you're only trading a few dollars. So in the case of a casual sale, there is no allowance for a trade-in. In the case of a dealer sale, it's whatever is on the bill of sale that you would deduct, okay? So now we know what we've got, what we're going to calculate the tax against, right? So let's look at what happens March 1st. Well, March 1st is, anybody looked at their calendar? It's a Friday. If you have gratis issues, what days do they occur? Friday or Monday. So we looked at, do we want to wait and really go live, full live on Monday? Well, that's probably no better than Friday. So we're going live on on Friday. If any of you tax commissioners in this room have Saturday office hours, I'm very nicely asking you to close your office on March the 2nd, so that if we have anything that surprises us March 1st, we have the weekend to react to that. So I'm nicely asking you to do that. So, assuming the world is the same, you're going to leave on Thursday afternoon, and when you come back in Friday morning, you're going to have a gratis that looks different and a world that's a little bit different. So, a titled motor vehicle purchased on or after March 1st will no longer pay sales tax, except if the owner of the vehicle lives in a county that put in T-Splost. And those are going to be counties that run sort of from the Columbus, make a pretty smile across the middle of Georgia and come back up around the Augusta area. So if you're north of that area, you don't have T-Splost. But in those counties that do have T-Splost, those vehicles are subject to that 1% T-Splost tax, which is that transportation tax, up to a maximum of for the first $5,000 of value. So the maximum T-Splost tax that would be collected on a vehicle would be $50. But they still would pay that. That would be collected at the dealership. The dealer would handle collection of the T-Splost. But for every other vehicle, it's going to be exempt from sales and use tax. These vehicles are not going to pay that annual birthday tax. They do have to pay the normal title and registration, the $18 title fee, the $20 registration fee. But then these vehicles are going to be subject to the TAVT, or this new alternate ad valorem tax. So one thing went away, something else, 2 things went away, and we added 1 thing. And guys, quite frankly, the title ad valorem tax looks and smells an awful lot like a sales tax. We're just applying it a little bit differently and applying it at a different place and tying it to the title transaction. It's also important to remember that these vehicles that are in the new system will still be subject every year to that annual registration. So even though they're not required to pay the birthday tax anymore, they still have to do that annual registration piece. All right, another change with this is because the counties wanted to be more, yes ma'am. That's okay.
So will the registration fee still remain the same, the $20 tax fee?
Mm-hmm.
Or what about if they have special tax?
Okay. I'm going to repeat your question and then I'll answer it.
Okay.
All right, her question was, will the registration fee remain the same and special tag fees have a University of Georgia plate, the special fee. Yes, those will remain in place, the $20 registration fee, and if they have one of the many special plates, then they would continue to pay the $35 special plate fee.
Even with prestige plates?
Yes.
Okay.
Yes, even with prestige plates. So those fees will stay in place, and that's still an annual requirement.
Okay.
What about if they're late on paying their registration?
All right, the question is, if they are late paying the registration fee, they are still subject to those same late fees. Interesting with this bill, everything that we're talking about today was put in Title 48, which is the tax and revenue section. Nothing in Title 40 dealing with titles and registration was changed by this bill. So all those requirements for title registration, deadlines, all that sort of thing still apply. So we've kind of overlaid the new on top of that existing legislation, which sometimes doesn't fit real well. Okay? Now another change is that the title work must now be presented in the county of the owner's residence. Up today, I could purchase a vehicle anywhere in the state I want to purchase it. And that dealer would have the option of taking that title work into any county he wants to take it and process the title work. Under this bill, because the title tax is attached to the title, and because it's due in the county where the owner lives, now all this work has to go to the owner's county. So this is a big change for some of you who do a lot of dealer work. Going to cut out on some of the work in your office. And for some of you who do very little dealer work, but you have folks in your county that buy new cars frequently, it's going to increase the workload in your county. It's also an education issue that you're going to have folks walk in, try to process title work, and they don't live there, or their customer doesn't live there. You're going to need to say, I'm very sorry, I can't process this here. You need to take this to the next county or 4 counties over. So this is a change, and one that will take a little time to get used to. The payment of the title ad valorem tax and the title application fee must all be paid together. Those things have to come in together. Don't think you want to take the title application and say, okay, I'm going to go ahead and process this, just get me the fee when you want to. Because chances are pretty good you might never see that person again. So the way Gratis is set up, everything is tied. You can't process and issue credentials unless the title ad valorem tax is paid as it should be. And then the next one is that all changes in ownership are going to trigger payment of the tax. Now that is almost all changes, and we'll talk about those as the day goes on. And some changes in ownership may have a different rate. But generally speaking, if there's a change in ownership and a change in that title, is going to trigger a title tax rate of something. And as we go through the day, we'll talk about which transactions may be done at a reduced rate. But we'll get into that a little bit later. A lot of that we'll do this afternoon. So how is it calculated? We spent a lot of time talking about that. We have the fair market value of the vehicle. We've spent time talking about how we find that number, what that number is. If we buy at the dealer, we get to deduct our trade-in value. And we're left with a taxable value times the rate in effect for the calendar year of the transaction, and that gives us the amount of tax we're going to pay. So let's look at a couple of scenarios. Let's look at what would happen today if I bought a car. If I were fortunate enough to be able to go to the dealer and I'm going to buy a $35,000 vehicle, which it's hard to buy one today that isn't that much, and I have a trade-in that's worth $15,000, I have a $20,000 taxable value, and that's, you know, there are other things that feed into that, but for purposes of our illustration, this works. This taxpayer that's purchasing this vehicle lives in a county with a 7% sales tax rate. So they're going to pay $1,400 in sales tax on that vehicle because they're paying on that net taxable rate. Now, this taxpayer lives in a county with a mill rate of overall 25 mills. So their first year, they're going to have an ad valorem tax bill of about $350. So year one, their tax investment in this vehicle is $1,750. Now in our new system, March 1st system, the title ad valorem tax is going to be calculated again on that net taxable value. So it's going to be calculated on $20,000. The rate, the initial title ad valorem tax rate is 6.5%. So this taxpayer will pay $1,300 in title ad valorem tax. So they've saved $100 already. And they're not going to pay that annual birthday tax, so they've saved that. So in year one, they've saved $450. Yes, ma'am?
For those vehicles that are bought at the end of the year?
Okay, the question is if there's a sale that occurs at the end of December 2013, and they come in to do the title work after the first of the year, what is the rate? The rate runs off the date of purchase. So if they purchase that vehicle December 31st of 13, the rate's going to be 6.5%. If they purchase that vehicle January the 2nd of 14, the rate would be 6.75%. So for those of us who buy at dealers, our life hasn't changed much, has it? Now, if I happen to live in a county where my sales tax rate is only 6%, I am paying a little bit more than I would pay in sales tax, but I'm still saving the amount of the annual ad valorem tax that I would be paying. So for those of us that buy at dealers, or those of you that buy at dealers, our world is still very much like it was, only we don't have to come up with that money every year to pay that annual ad valorem tax. However, let's look at our casual sale people. Now, this example is a little bit exaggerated for the type vehicles that normally are the casual sale, but I'm just using the same vehicle number. It's a $35,000 vehicle. Again, there's no trade-in allowed on it. But today, if the person bought that $35,000 vehicle, all they would be required to pay at the county to transfer title is how much money? $38, right? All day one day last week I was saying 28. Somebody nicely at lunch reminded me that I couldn't add. So I do know now it's 38. I was saying 28 all day. I don't know what was wrong with me. But for $38, they walk out with a piece of paper, or will soon get a piece of paper, that says, I am the proud owner of this automobile. Now, after March 1st, their world significantly changes. Because in order to go in and get the title transferred on that vehicle, you're going to look them, if you're at the tax commissioner's office, and they're going to hand you $38. They're going to hand you the title application and their registration money and their title application fee money, and they're going to say, I want to get a new title. I just bought this car and I need to get my title. And you're going to say, I am so glad you came to see us today. Because I will be glad to process this title application for you. But in order to do that, you owe me $2,275 plus the $38. Now, when you've picked this poor fella up off the floor and said, okay, you know, gotten the EMTs in to revive him, you explain the new process. This is the group of taxpayers we need to educate. Now, my example is certainly an exaggerated example for most of the transactions that happen in the casual sale world. But if I'm a person who can only scrape up a few $1,000s to buy a vehicle, that's all I had, and now I walk into your office and you tell me I owe you a couple of $100, I'm in the same place. If I can afford to buy a $35,000 car from somebody, I could probably come up with $2,200. But if I can only scrape up $3,000 or $3,500 to buy a vehicle, and you tell me you need $250, I'm in that same financial pinch that I would have been in the first case. So these are the taxpayers that I think are the ones that are going to be, number one, they're going to be shocked. They're not going to understand. They're going to think we changed the rules and didn't tell them, and we did. Because the stories out there aren't necessarily telling them the whole story. So these are, yes ma'am.
What if you want to go buy a used car for somebody you're buying?
Okay. Question is, you go buy a car and you want to have it for your child. You would be able to, you may title that vehicle, but you still are going to, initially you're going to have to pay the full title. Even if you transferred one to your child, and we'll spend some more time talking about that, there is a special rate for a family transfer. But on the initial transfer where you bought the car and wanted to get the title, you're going to be subject to the title rate of whatever the value of the vehicle is. If you then want to transfer it to your child, you can do that at a reduced rate. Or you could go straight from the purchaser and put it in your child's name, but it will be subject to the full tax. Okay?
The age is not going to change. I mean, like anybody under the age of 18, we're not going to be able to title.
Right. The age hadn't changed. Any of those current laws that deal with who can be on a title, 18 and older, hasn't changed.
Okay.
Yes, ma'am.
Just a question. I thought you could get a title put in your name if you had a Georgia driver's license. I didn't know you had to be 18.
You don't have to be 18. My expert back here tells me so. So I guess you could be 16. You would have to have a driver's license. They don't have a Georgia driver's license. They may have a learner's, but they don't have a Georgia license. Yes. You could. You could, and I doubt they're going to get anybody to cover insurance for them with that car in their name, but that would be your second thing you'd have to look at. Yes, ma'am.
I've already been asked, is this going to be deductible of the Valorem taxes now?
Okay. Nobody asked that question in a couple of days. Her question is, will this new title ad valorem tax be tax deductible for income tax purposes? No. The reason no is, and I'll say no and I'll qualify that no. For federal tax purposes, the Internal Revenue Code says in order for an ad valorem tax to be deductible, it has to be a recurring tax. In this case, it's not a recurring tax, it's a one-time tax. Now, there has been a proposal in the General Assembly to make this title ad valorem tax deductible for Georgia tax purposes. But of course, that hasn't passed yet, and we'll just have to wait and see if it ends up being passed for Georgia tax purposes. Now, I suggest if somebody in your office asks you that, to be very careful giving tax advice and just tell them they probably need to check with their CPA. But that's the information that we've been given or that we have decided looking at it. Okay, any more questions on, yes ma'am?
Just a quick one, you're talking about still between families being different. If there was a mother and a son on a title, and then when the son got older, the mother took her name off of it, how is that going to apply?
Can you hold that question till later? You'll be here all day, right? Hold that question till later. Because we'll get some lively debate, and we probably want a smaller crowd so we can argue through that one. All right? Now, let's talk about, we've got our money in, right? At least we have money from one transaction. It's either $1,300 or $2,200, whichever one of those would be our case. Now we have to figure out what the heck are we going to do with this money? Okay? First of all, in this bill were some guarantees made to local governments. The local government folks were very involved in how the revenue would be distributed through this bill, being very sure that they came out of it basically at least as good, if not better, than where they were. So the legislature and the fiscal folks and some of the local government folks said, okay, let's look at what the best years in recent history have been for local government revenue. And it was basically determined that 2007 and 2008 were the best years for local governments. Now, we know why. Everybody was fat and happy, right? We were building houses, we were buying stuff, we were spending money, Development was going on. There was lots of stuff. There was huge amounts of growth in most counties. What happened late 2007, 2008? Like the brakes got put on, right? Everything stopped. That's why we have all those PVC farms around everywhere, right? They're growing PVC pipes sticking up. They're still not developed. So the economy began to go the other way then. Tax digest began to decrease. But basically 2007 and 2008 were very good years, both from sales tax and from property tax. So those were the years that they say, okay, we estimate that local governments in those years brought in as a whole, all local governments together, $1 billion. That's a lot of zeros out behind the end of a number, right? So that's one number that you need to keep in mind is the $1 billion. All right, the next definition that's in the statute is local current collection amount. That is the amount of ad valorem tax collected in the prior year. In this case, prior year refers to 2012. So the amount of ad valorem tax you're collecting monthly in 2012 is going to come into play when we start talking about how we're going to divide this new money up. So just keep all these little things in your head. Now we have a local target collection amount. This is the amount that we're going to work through our system to make sure local governments, again as a whole, collect. So in 2013, it's going to be that $1 billion. Guarantee that they're going to match those good years. We're going to add 2% to it for 2014. We're telling local governments you're going to get $1,020 million. 2015, we're going to add another 2%. So we're going to give them $1,040 million. Now, it's interesting in this bill that everything kind of rocks along and every year is indicated up to 2022. Now, I'm not sure, does that mean that we stop, that the world stops in 2022? Or that just they decided to project sort of 10 years out in this bill? Now, so we have the local amounts. We know there's something that we're promising or has been promised to local governments. Now, I don't want to get left out, so there's an amount promised to the state. The state base amount is $535 million. Now, the state's stake in the property tax world is very low, right? In 2012, for motor vehicles, bless you, twice. In the motor vehicle world for 2012, your millage rate is what for state tax? 0.20, right? Because the state millage rate has begun to decrease. So the state millage rate is low, but state gets a large portion of sales tax. We would get 4 cents on the dollar for sales tax in a motor vehicle sale. But the state amount is the $535 million. We're also going to look to see that the state is staying at that amount and what they would collect in 2015 based on where we are, assuming that we would be up to 7% in 2015, and we'll look at what that means in just a minute. And then we have the state target collection amount. So this bill also tells the state, all right, you're also going to get 2% increase on a yearly basis. So in 2014, we're going to add 2%, which means we're going to get $545,700,000. And you see for 2015, we've added another 2%. Well, how do we make this happen? How do we determine this? Well, there's a couple of things. There's a state target amount. The state has to meet a certain amount of money, in which case, if the state isn't getting the amount of money they need to get, the overall rate may be adjusted. Now, the overall rate is that 6.5, 6.75, and 7. Now, it's going to be 6.5 in 2013, 6.75 in 2014. 2015, it will go to 7%. Now, if everything stays great and we're all meeting our targets, it would stay at 7%. But should the state not get sufficient money, and we'll talk about why that might be as we move through the slides, then the overall rate may have to be adjusted up, in which case anything over 7% would belong to the state. And in my world, what goes up normally what? Never comes down, right? But then there's the local target amount, and that adjusts how the money is split between the state and the locals. There's a bucket of money, and we're going to take a certain amount and split it off, and we're going to send it to the state, and then there's a certain amount that will be sent to the locals. In the first year, the state's going to get 57% of the title ad valorem tax that comes in the door, and the locals are going to get 43%. Now, does that make sense to you? Who's getting the bulk of the ad valorem tax coming in today? You are, right? Very little of that money comes to the state. So, assuming that in 2013, there's still going to be tons and tons of vehicles on the ad valorem system, the theory and the underlying hypothesis is that there will be sufficient revenue coming in from ad valorem tax that you can split this money this way, and the state and the locals will get their share and the state will get theirs. I think you'll see on the next slide that over the years that we have projected in the bill, that split begins to change because the ad valorem tax should continue to decrease for a couple of reasons. More and more vehicles will be moving as they change owners, will be moving over into the new system, so they won't be paying ad valorem tax anymore. And those vehicles still in the ad valorem system are going to be depreciating, so their value will be dropping. So the only reason that would stop that would be a fairly large increase in millage rate, in which case probably be more unhappy people, right? Because that doesn't just affect motor vehicles, that affects everything. So this is the way the splits are projected in the bill. However, they are subject to change, but this is the initial projection, and you'll see they gradually begin to move more and more over to the local side. But let's see what would cause us to change a couple of things. What would cause us to change here and maybe give more to the locals? Or, what I don't think is extremely likely to happen, that we would change it and give more to the state because the locals were bringing in so much money. But we'll talk about that. And then what might change this rate here? So, every year, beginning in 2016, the rates are set for 13, 14, and 15, and the splits are set for 13, 14, and 15. But for 16, the commissioner is going to have to look and say, okay, local governments have met their target. So we're looking at $1 billion plus $60 million by 2015, right? Is that right? And then we're going to project, do we think locals are going to be there in 2016? If they're within 1% of that, nothing changes, and we continue to use that split we just looked at on the chart. If, however, in January of 2016, we look and say, locals aren't making their target, we need then, and if it's by more than 1% less than their target amount, we are going to then adjust that split and give the locals more money. If the reverse were true, and everybody was bringing, or the money was rolling in, we could, if the locals are promised that amount, if they're getting that amount, getting 1% more than that amount, any amount, we would adjust the split so that the additional money would go to the state, and the locals would be kept at whatever their target amount is. Now, fortunately, you don't have to do that. This is something that a determination that will be made out in the department. The authority's been given to the commissioner to make this determination, and if the rates change, we will handle that maintenance and gratis so that I'm not counting on 159 counties to do that for me. I love you guys, but I don't think I want to count on 159 of you to get that number in there the right way. Okay? So we'll make that determination. We'll also tell you by the 31st of the month what that split's going to be. Okay? Everybody with me so far? Now, until January the 31st comes and we tell you what that split's going to be, you can't make a distribution out of TAVT money because you don't know how to distribute it, right? Because we haven't told you what the split is, how much of it comes to the state, how much of it is local. So the first distribution can't be made until we give you that information, but we will do that, and it probably won't be right at the end of the month. So that's the first thing that's going to happen beginning in 2015. Also in 2015, in July, the commissioner is going to look and make some determinations whether or not the state is getting their amount and what's kind of going on with the locals. Are we looking at an adjustment for the locals? And if it looks like we're going to need to give the locals more money or change that percentage, then the state would be short, right? They're not going to make their target amount. So the only way to make that adjustment then would be, that's when the rate would increase. So it could go, for example, from 7% to 7.5%. Now, if that's going to happen and that's the determination of the commissioner, we then have to make that announcement publicly no later than, I believe it's August 31st. And that new rate, overall rate, would be effective that upcoming January. So if that were to happen, if the rate were going to go from 7 to 7.5, chances are good that car selling business is going to get pretty active in November and December, right? Folks are going to be trying to buy while that rate's lower. But that announcement would be made. It would be made to the tax commissioners, but we would also make that as an information bulletin that would go out statewide so that car dealers and everybody would know that that rate was going to change. That rate can be adjusted in those years. The 15, 18, and 22 are the years we'll look at that rate. So if we make that change in 2000, look at it for 15, it would be effective January 1 of 16. That's the rate that would stay in effect for the next 3 years. Now, we could adjust the split if we needed to, but the rate wouldn't change because we don't review that overall rate again for 3 years. That's why I say what goes up normally doesn't come down, right? Now we've got money. We got to figure out what we're going to do with it. How are we going to spend it? All these buckets of money that are piled up in the tax commissioner's office, right? All right, you've got money coming in from the title ad valorem tax. There will be some money still coming straight into the Department of Revenue, and that's for salvage vehicles. Salvage vehicle process will still be handled at Department of Revenue Motor Vehicle Headquarters. There will be some penalties. You will collect penalties for people who pay late. And we'll get into the penalties on a little bit later. Yes, ma'am?
Sorry, I have another question.
That's okay.
Now, are all counties going to be able to do salvage titles?
Her question is, are all counties going to be able to do salvage titles? No. You won't do salvage titles. Yes. There's even a process, and we can talk about that later this afternoon, about how we'll handle rebuilds so that they actually pay the money to you, but we've done all the upfront work. And we can talk about that this afternoon. But there are penalties if people pay late, and there is interest if folks pay late. So all that money has to go into the big pot, and we're going to distribute that. You cannot distribute out of the title, you have to distribute by 30 days at the end of the month. So March ends on the 31st, right? March has 31 days? Okay. So you have 30 days from the end of March to distribute the title tax money. The other thing is you cannot distribute title tax money until after the end of the current month. And we're going to talk about why, which is different a little bit from how most of you do ad valorem tax today. First of all, we've got to pay the state. So the first thing we're going to do out of this big bucket of money is we're going to take 57% of that money and we're going to give it to the state. So that's the first thing you're going to do. So you're going to take and you're going to give the state our share of those fees. When it comes to motor vehicle, and this money will be sent in through motor vehicle because it's all being tracked through gratis. So even though it's called an alternative ad valorem tax, for those of you in the tax commissioner's office that typically submit state ad valorem tax to me on a PL 65 every month, you will continue to do that for the old ad valorem tax, but this new title tax money will actually come in to motor vehicle headquarters with gratis reports. So it's a little bit different in reporting of the two taxes. So you're going to send that to the department, and we're going to take that check or right out of our account if you send that to us electronically, and it goes straight into the general treasury. It doesn't stay with motor vehicle division. Now, before you send us that money, you're allowed to deduct a 1% admin fee for handling and collecting our money. That was kind of the, we keep 1% admin fee of sales tax when we collect local sales tax for you. And so it's like, okay, fair's fair. Y'all get 1% on the sales tax, local government and the county will keep 1%. There are some expenses involved in this, and we're going to talk about those later in the day. So in order to offset some of those expenses, the 1% admin fee will be collected and goes to the county general fund if the tax commissioner pays timely. The tax commissioner doesn't pay out within 30 days, doesn't pay the state within 30 days, you forfeit that admin fee. And you owe me 1% interest. Now, I expect that's only going to happen one time, if ever, because typically you've got 30 days. That should be sufficient unless there's some extenuating circumstance in the county. But typically 30 days would give you sufficient time to pay out. So I don't really expect that to happen, but they put the leverage in there to make sure, I guess, it didn't happen. It's a little bit of a hammer. So the money flow, the money comes in through the tax commissioner's office. Now, currently today, tax commissioner gets title money, registration fees, collecting that ad valorem tax on motor vehicles for all jurisdictions in the county. They're collecting those insurance lap fees, which I know you guys love dealing with that. But now on top of that, you're going to collect title ad valorem tax. You're going to deposit that money into your account, and from that account, you're going to make the distribution. So it's just the way the money's going to flow. Now, the reason that we talked about, I said you couldn't distribute title ad valorem tax for 30 days until after the end of the month, right? I said you couldn't start that distribution until the end of the month. The reason is we have to look at the amount of ad valorem tax collected and make a determination. In March of 2013, did I collect the same amount I collected in March of 2012? And the only way I can do that is wait till the end of the month till those collections are in, right? So that's why you have to wait. So you're going to look at those ad valorem tax collected for all the jurisdictions that are in your county. Special districts, fire districts, school systems, everybody. You're going to look at each one of those levies individually and determine, are they equal to or greater than the amount of money they collected in old ad valorem tax for the same month in the prior year. So that's why you've got to hold on to that bucket of money until the end of the month, so we can do this, what we call true up in this amount of money. So we've already paid the state, so this is the money that's left there in the county. In this case, that 43%, I think it was. So in the current process, you're paying out ad valorem tax, some of you weekly, some of you every 2 weeks, some of you by agreement with your local folks and your school boards are only paying out once a month. That process can continue. You can continue to pay out the old ad valorem tax, what's calculated based on a millage rate, the same way you're paying today. So that process won't change. However, you still have to keep separate this title ad valorem tax until the end of the month. So we can look and see what we need to do. Now, you're still getting ad valorem tax. We talked about this a little bit earlier. Those titled vehicles with no ownership change. There's a lot of us that drive cars till the wheels fall off. You're looking at one. Of course, the way I'm traveling lately, it won't be long till the wheels start falling off mine. And then you have those non-titled vehicles. You have those older vehicles that don't have a title. You have the anything that's pulled, it's not self-propelled, those will continue to pay the ad valorem tax. So you're still getting ad valorem tax from those things. But let's look at now how we're going to true up, what we're going to do about looking at where we are and what we need to do. In this particular example, and this is a very simple one compared to how complicated some of your millage rates are and how your collection system works in ad valorem tax. In this case, you just have a county rate and you have amount of money collected just for county M&O for March of 2012. Gratis knows what that is, because we'll go back and look at those ad valorem tax collections that came in through your office for motor vehicles for that month in 2012. We're then going to know, because we've waited till the end of the month, exactly what you took in March of 2013. Now, I realize that some of that is prior month, prior year, but we're just looking at it kind of as everything that came in that month, because that's the cleanest way to try to match this up. And there's going to be a difference here. Most likely, it's going to be that you didn't collect quite as much money in 2013 as you did in 2012. Now, that may not be the case in March of 2013 because a lot of vehicles haven't yet begun to move over into the new world. But you do have the opt-in folks and some other things that will affect that, so it could be. Don't know till we're not going to know till after March ends exactly what March looks like. So this is the first thing you have to do. Now, here's an example with some numbers plugged in, and the 2012 numbers in this case are real-world numbers. We've just made some guesses of what we think 2013 might look like. And in this particular case, this is what came in 2000. This is the amount we need to match up to, which is a total of $338,000. And ad valorem tax in this particular case, as over the whole for the county, is $322 million. So the amount we need to make up is $16,000. So we have to take $16,000 out of our money left in title ad valorem tax. And as you can see, we got to put a little bit into each one of these in order to get these folks back up to where the same amount of money they had in 2012. So that process, again, can't take place until the end of the month. Nobody asked this question. Yes, sir.
How do you take into account tax millage rate change?
I need you.
You've got a different tax millage rate in 2 years. You're comparing oranges and apples. How do you deal with that?
You're simply looking at dollars. Okay, you're simply looking at dollars. So the millage rates may change, but you're still comparing dollar to dollar based on that. Again, getting back to that same dollar amount you got received in 2012. So, nobody asked this question in this session. This is the first time nobody's immediately raised their hand and said, what happens if I don't have enough money?
Probably looking too far down the road, which I've been known to do. But this seems to, or at least the potential has significant impact on sales tax credit that's applied to local millage rate.
You're
on
correct.
down the road.
You're correct.
Unforeseen circumstances in many counties. apply that in any shape or form. What was traditionally applied no longer going to be applicable.
The question is, those of you who have local option sales tax, do a millage rate rollback equivalent for the amount of local option sales tax that comes in. And that's a rollback that applies to the entire county. You're correct that there's no provision to include this in any sort of rollback. So, you know, hopefully sales tax revenues will stay. You know, how much sales tax revenue is directly attributable to car sales is a very difficult number to pin down, because even if I look at what dealers send in as sales tax, that also includes other things that aren't the sale of the car, parts, some of the things that go on there. So determining exactly and knowing how volatile sales tax is, you're absolutely right. It could have, as we move forward, you would have less money in that pot that makes your rollback rate. So you are correct.
Vicki, this true-up money comes from the portion we send the state?
No. My money's coming out first, all right? And we're going to take my money first. The true-up money will come from whatever, in our initial example, the state's going to get 57% of that pot of money, and the locals are going to get 43%. So you're going to send me mine first. It's all about me, just so you know that. Then you're going to have that 43%, and out of that 43%, you're going to true this up. True up the ad valorem tax. Then if there's anything left, or what is left, we're going to distribute on a different formula. Okay?
Now, will Gratis do that for us?
Will Gratis do that for you?
When I get back to the office, that's going to be a question.
Almost always. You have some input as to how title tax is distributed. Gratis will walk you through this true-up process. Okay, Gratis is going to walk you through that so that that's done. But now, let's say in March of 2012, I have that $16,000 shortfall in ad valorem tax. And I don't take in $16,000 in title ad valorem tax in March of 2013. And that is very likely to be the case, because the casual sale person has 30 days to pay the title tax. If I have 30 days to pay something, chances are really good I'm going to pay it on day 28 or 29. Most of us are like that. We're going to put it off. So I don't expect somebody's going to buy a new car and they're going to come flying into your office anxious to hand you a couple of $100. So they're going to wait. So it's very likely you won't have a lot of title ad valorem tax coming in that first month. So you may have a shortfall in the first month. Yes, ma'am.
The new owner has 7 days to register the vehicle.
Yes. All right. That's come up every session. This is number 6, and that's come up every session. Current statute says the new owner in a casual sale is supposed to go register that vehicle within 7 days. However, this new law doesn't require them to file the title application and pay the money for 30 days. Now, there is no penalty at that 7-day now. We're not imposing a penalty if they don't do it. Law enforcement will get them, but you're not going to impose a penalty. So they still need to come in. The only option you would have would be to do something where you could issue the TOP, give them some time to then come back in. But all right, in this case, we don't have enough money. We don't have enough money to true it up. So what are we going to do about it? Well, Gratis is going to help you with this, because we don't want you, the tax commissioner, to be in the position to decide who you like best this week. You know, I've only got a small amount to pay, so I think I like the county better this week, so I'm going to pay the county, and I'm not going to pay anybody else. So we don't want to put anybody in that position, so what we're going to do is say, okay, we're going to add up all those millage rates, and we're going to figure out proportionately. Tell y'all a sidebar. Yesterday, we were in a different type facility, and I kept hearing something behind me. And I thought, what is that noise? And I really thought it was the bathroom, because the bathroom was right behind me. Late in the afternoon, we finally realized there's this air freshener thing that's spraying about once every, I don't know, 5 minutes, it seemed like, and just really would drive you nuts, because it was standing, it was right behind my head. So we're going to take those millage rates and we're going to add them up, and then we're going to say the school is 54% of that number, the school millage rate. So we're going to take that bucket of money, we're going to give the school 54%. We'll give the county whatever their percentage is, and down the line. So everybody gets something, but nobody gets fully paid out generally. Now we're going to track that into the next month. So that the next month we're going to look at April of 2013, what do we look like then? Do we have enough to true up April of 2013? And if so, can we also finish what we owed for March of 2013? And this is going to continue until you get it all made up.
Basically, we're borrowing from Peter to pay Paul.
Yes, good analogy. Borrowing from Peter to pay Paul. Let's hope not. Let's hope the whole theory underlying this is there's going to be sufficient money to do both. Now I can see, I think March 2013 may be a little bit tricky. But we'll see. But I think it will level itself out as you move through the process. People tend to buy vehicles. There's about 1.7 million vehicle transfers a year in the state of Georgia. You hope a lot of those are in your county, so that you're the one who's always has the money to make it up. Can we turn some air on?
I think that's what you need. That's what the noise you heard.
That was the noise I heard? Okay. And I'm going to give you a break in a few minutes, but not right this minute. You're working on the air? Thank you. I was warm, but I figured it was just because I was up here. Now, we have money left over, because we're going to be positive about this, right? We have money left over, and we need to figure out what we're going to do with it. So we're going to divide our pie. We're going to make a pie out of this additional amount of money, and we're going to split it into thirds. Guys, I like pie, so I want big pieces of pie. Cutting pie into eighths is for the birds. I want a third of the pie. When we distribute this money, always, 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 and you probably won't hear that out of my mouth again today, always, 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 the first third of that money goes to the school or school systems in your county. If you have just one county school system, they receive all of that third. If you're in a county that has multiple school systems, you may have a couple of independent school systems or one independent school system, then you have to divide the money between the two school systems. We'll talk about how you do that. Generally speaking, the second third of the pie, which in this case is our green third, is going to go to local governments. We will talk about exception to that, because I said I'll never say always, always, always again, right? There could be an exception to that, and we'll talk about what those exceptions would be. And then the final third almost always goes to local governments, but there is one exception to that. So that's always how that process works. Now, before you can start distributing this next third, or these thirds, you really need to have some understanding of sales tax and what the sales tax makeup of your local jurisdiction is. So we're going to have a quick sales tax lesson before we go on our break. Most counties have what's called local option sales tax. It's a county tax, but the money is shared between the county and municipalities based on their negotiation, and they are required to file a certificate with the commissioner We are in the process of, counties were just required to go through, and cities, to go through that renegotiation process. They're required to do it 2 years after the census is completed. So December 31st of 2012, everybody was supposed to have been through that process and given the department or the revenue commissioner a certificate for how that money is going to be split. Now, folks can't always get along. So we have a large group of counties that haven't been able to reach an agreement yet, because the city wants more and the county wants more, and so they've gone to what's called the baseball arbitration, and the judge is ultimately going to say who gets what. So if there's no new certificate on file, then you will disperse based on what was in effect on December 31st. Now, your county has a copy of that certificate, and you need to have a conversation with them. If you just can't get it out of the county, you can come to local government services, because we have copies of those certificates. Now, there's another kind of local option sales tax, but in this case, in 8 counties in the state, that local option sales tax is dedicated to the school system. Those are Bullock, Chattooga, Habersham, Colquitt, Mitchell, Rabun, Towns, and Houston. Okay? In those cases, that sales tax goes to the school, and we'll talk about what that does in the distribution formula after break. Then we have special purpose local option sales tax. That's that 1 cent that may belong to the county or it may belong to the school that is used for capital projects only. It's voted on, it's on a referendum, there's a set period of time, there are set projects that are going to be built using that money. Very likely the new courthouse up here that they're building here in Forsyth County is going to be built with SPLOST money. Where I used to work many years ago, we built a courthouse using totally SPLOST money. So that money has to be used for that agreement. When you're looking at distribution of this third, if the school has a SPLOST, they don't play into this formula of distribution. It's only the county SPLOST that plays into that. We will also talk about what that may do to some SPLOST referendums and that kind of thing. Then you have HOST, which homestead option sales tax. We only have 2 counties in the state that have homestead option sales tax. You may know who they are? Rockdale, DeKalb. Rockdale and DeKalb. So I don't know that I have any of those folks in the room, but we'll just generally talk about what that is. And in their case, they take that sales tax money, and instead of rolling back the millage rate on every piece of property in the county, they only roll the millage rate back on those folks who have homestead exemption, or roll the value back on those folks with homestead exemption. And then we have MARTA tax, which is to support the rapid transit system in Atlanta. And that would only apply to 1 county. So before we get into this distribution, because it gets a little, you have to think about what you're doing, why don't we, hopefully it will cool off while we take about a 15-minute break. I'm going to start back at, I don't know what time, and my watch is a little bit slow. Who has a, 10:30. I'll start talking.